What is your expectation on the result of the FMC in May? Will they raise the benchmark rate by 50 BPs and start shrinking the balance sheet immediately?
Yeah, our expectation is that they will raise by 50 basis points. That seems to be what they are guiding the market to. And the Federal Reserve has made a habit of not wanting to surprise the markets at the meetings themselves. They prepare the markets ahead of time. And they will probably start reducing the balance sheet shortly thereafter. Probably June would be the most likely starting date, but regardless if it's May, June, or July, the balance sheet will be shrinking in very short order.
How many 50 BPs hikes do you expect this year?
Yeah, it looks like two in the short term. So May and June would be the most likely candidates. And at that point, the Fed may be able to slow down the pace of hikes from there because, number one, inflation at that point should be starting to come down. And that would give the Fed some cover. But also, the Fed's first objective is to get to a neutral rate, which is probably between 2.25% and 2.5% on the Fed funds rate. And so that would, if they do 250 basis point hikes, then they could go at a slower pace and still get to neutral by the end of 2022. And the other point would be that they could use the Fed balance sheet reduction as an additional lever, so they could perhaps slow down the pace of hikes, but then keep the balance sheet reduction at the same pace, or even accelerate it if they choose to go that route. So they have a few different things they can do to tighten policy besides just raising rates.
That means you think the James bluffing somewhat.
I think the Fed has been throwing out trial balloons into the markets to see the market's reactions. They certainly did that with the first rate hike and then going to 50 basis points. And so the idea of 75 basis points at one meeting is a possibility, but I think the Fed is just seeing what they think would possibly be the market reaction to it. But they don't need to go that fast if their objective is to get to neutral, by the end of the year. They don't have to do it all at once.
Every market participant, I think, they expect the Fed will make the neutral soon, very expeditiously, but the QT, everybody don't think about the result of the QT. What really gonna happen after QT starts? And is there any possibility that the start of asset reductions will have an unexpected stock shock on the market?
I think you would see risk assets like stocks and housing be some of the first areas to feel the effects of quantitative tightening, and so that would be our expectation, is that would be part of it. Now, I think a difference between this cycle and what happened the previous cycle is that the Fed has really laid the groundwork, and you've seen over the past year a lot of the riskiest areas of the stock market, small cap stocks, unprofitable stocks, have already had pretty big corrections. In fact, almost half of all NASDAQ stocks have had declines of at least 50%. And many of those stocks have been down that much, are of the smallest, most illiquid stocks. So I think we've seen some of that effect already. But I think that the Federal Reserve is going to be trying to balance a lot of different things here, not only interest rate expectations. They also are going to be trying to manage the yield curve somewhat. So that would be a way to use quantitative tightening by selling more bonds. Long-term interest rates could rise more, and that would allow the yield curve to stay positive, or long-term interest rates to stay above short-term interest rates, because the Fed is well aware that an inverted yield curve often leads to recessions. So there's a lot of things they can do with QT, and they'll just have to manage all the pros and cons of the different measures they have at their disposal.
Yields on 10-year treasuries have risen a lot recently and are falling a little bit today. On last Monday, Barclays recommended a stop loss on the 10-year notes, and today, Bank of America said it has turned long on 10-year treasuries. Which side do you think is correct?
We have been bearish on bonds for quite a long time. We've gotten a little bit less bearish than we have been before, but we still are negative, say, over the next 6 or so months.
Oh.
So we think bond yields will move higher. But short term, we have some sentiment data that we follow that shows there's a lot of pessimism towards bonds. Bond yields have already risen as much as they normally do during a tightening cycle. It just usually takes longer to get there. So that would be a case again for bonds that pause and then maybe yields work their way higher a little bit later on in the year.
I read your report, the market leadership is a mess. And can you give a brief summary to our viewers?
Sure. The strongest moves in stocks are usually led by the most economically sensitive and highest beta, most volatile areas, like small cap stocks, like financial stocks. And so we look at several different relationships like that, and some of them are showing some leadership trends, like stocks that don't pay a dividend are rallying when the market goes up and declining when the market goes down. That's what you'd expect. But other areas like small caps are not. Small caps are outperforming when the market goes down and underperforming when the market goes up. And that kind of action is not what you typically see when the market's ready to rally very strongly. So our takeaway from that is that over the next few months, the stock market in the U.S. is probably going to be in a broad trading range that it's been in the last few months, in about a 7% range. And then we'll have to see which way it breaks to the downside below, say, 4,200 on the S&P 500, or break out to new highs. But until leadership gets more decisive, there's not a whole lot that we expect from, say, the Dow Industrials or the S&P 500.
What is your trading range? Is 4,200, 4,600, something like that?
Yeah, that's a nice range. 4,700 approximately, was the high in the S&P. But really, if you take out a few days in late December and early January, the 42 to 4,600 is probably a better range to focus on.
Mm-hmm. And if it breaks, is it likely to go up or down?
I would think between now and early in the third quarter, it's more likely that the market would break down. Mm-hmm. At that point, as we talked about earlier, the Federal Reserve will have hiked a few times, and inflation rates are still going to be looking fairly high, and that could push the market to potentially break below the March lows. And then at that point, the Federal Reserve could be looking at general financial conditions, which is something that they do follow. They could look at things like credit spreads, corporate bond yields versus treasury bond yields, loan quality and loan growth, and also risk assets like stocks. And they could conclude that the market is already doing some of the tightening for it, and that would give it a reason to slow down the pace of hikes. And then on the back of that, the stock market could rally from there. And then you could see the stock market in the U.S. potentially move towards new highs by the end of the year.
Mm-hmm. Despite Fed tightenings and rising market interest rates, the stock market is holding up very well, I think. The S&P 500 is only still only 6% off its high. And why do you think it hold up well? And do you think the bottom is behind us, or should we test the low again in the near future?
Yeah. I think at least a retest of the lows is probably the more likely scenario over the near term, and then potentially even breaking the lows for a short period of time. And so I think there's a couple things going on. One is that a lot of stocks have had big corrections already. It's just the largest stocks have not, for most, but there have been some that have. But there's also been what we call a rolling correction, where some sectors go through corrections while others are holding up, and then another sector goes through a correction, and the ones who are already corrected have come back. And so that means that broad indices like the S&P 500 don't have as much of a pullback. But there does seem to be a broader sense that perhaps a washout type of panic selling that we saw a little bit of in February and early March around the Russian invasion of Ukraine hasn't quite gotten to the extent that you typically see before the market can truly move higher. So there's probably some more downside volatility over the next few months.
Bill Dudley argues that if stocks don't fall, the Fed needs to force them. Do you agree?
The Fed does look at lots of measures of financial stress, and stocks are one of them. I think targeting a specific index or just one asset class is probably too bold of a measure. The Fed's mandate is price stability and full employment, not a valuation level in the S&P 500. So I wouldn't be too excited about them targeting it, but it does, from a broader sense, to cool some of the overheating in the economy would be expected, and you would think stocks should reflect that by a further pullback in some of the indices.
May is now 10 days away. There is a saying that the sell in May and go away. What do you think of this maxim in the current situation?
It's surprising that it has generally worked fairly well, even though so many people know about it. But what it really says is that the strongest gains happen from November to April. Right. And that May through October is kind of a weaker, kind of flat for the U.S. stock market. But I think a lot of the concerns going into May are still there. And then as we move deeper into the year, some of those concerns should be going away, as we talked about earlier, about maybe the Fed could slow the pace of hikes. Also in 2022, it's a midterm election year in the U.S., so there's not a presidential election, but there are congressional elections, and traditionally the presidential party loses seats in a midterm year, and the Democrats have very narrow majorities in the Senate and the House of Representatives. And so that's probably going to overhang the market as well, and that could be another reason for stocks to be on the defensive until it becomes clear which party's going to win Congress in the fall. So all those things kind of support sell in May and go away, not because it's a nice saying, but because the fundamentals and the political risks warrant it right now.
When do you expect to buy if we sell in May?
Well, I have to see when we get there and watch our indicators and models. That's how we do things. And so we would look for more extreme pessimism and signs the Fed is ready to move, and also that that earnings expectations, which have stayed fairly high, we'd like to see them come down a little bit further. And that tends to happen in the September timeframe. So I'd say somewhere late in the third quarter, would be one time to look for the market to make a bottom, and that is when in midterm years the market tends to make a low.
What's your target of the S&P 500 at the end of this first half, and not first half, end of the June and end of this year?
Yeah, for June, we would expect it to be close to the support around 4,200 about then, and then by the end of the year, we wouldn't be surprised at all if the S&P made new highs, and so we have a year-end target of 5,000 for the S&P.
Still 5,000. Huh?
Yes, yeah. So that would support the case for a pretty good year-end rally once we get through some of these headwinds.
And if inflation is inflation past its peak, and will it go down from April? Or do you think stocks will go up if that happens?
A very broad sense in the next inflation report that inflation has peaked, then I think the market would interpret that to be quite positive. The next report, I think, will be more of a mixed bag, where you're going to see some signs of inflation rolling over, but it's really going to be closer to the end of the second quarter, so the June or July report, before I think it's going to be very clear that inflation is rolling over. That's when the year-over-year effects are going to be clearest. And at that point, too, we'll have a better sense of things like global supply chains related to the pandemic, and also any sort of agricultural commodity supply concerns relating to the situation in Ukraine.
This stock market, the defensive stocks are doing well relatively. And is this U.S. economy late in the business cycle right now? And if so, is it right to invest in defensive stocks such as utilities?
Yeah, the leadership that we talked about earlier is much closer to mid or late cycle leadership than early cycle leadership. So right now, we favor energy and materials as a way to hedge against higher inflation, and those seem to be the parts of the market with the best ability to grow earnings. But also some defensive areas like utilities and consumer staples. Those sectors tend to do well later in the cycle. They also are historically oversold. They tend to do poorly at the beginning of a bull market, but even for the beginning of a bull market, they really did poorly in late 2020 and well into 2021. So they are still long-term oversold. So the cycle is moving in their favor. Technically, they're oversold. So some of the defensive areas would be a place that we would look to allocate our equity portion of the portfolio.
There is a lot of talks about the recession. When will it come? And how likely do you think the U.S. economy will be in recession this year and next year? When do you expect the recession to start?
The recession in the U.S. really depends on the job market, because the economy is about 2/3 consumer spending, which really depends on job growth and income growth along with that. And the job growth in the U.S. continues to be fairly strong, so that's the main thing to focus on. Now, there have been some warning signs, like the yield curve looking at 10-year Treasury yields versus 2-year Treasury yields briefly inverted, and that tends to precede a recession. Also, the Federal Reserve usually goes too far. They tighten too much and push the economy into recession, and so Fed tightening cycles are a thing to worry about. But the lead time between when those events occur and when the recession actually takes place tends to be very long. In fact, on average, it's over a year between the yield curve inversion and the start of the recession. So those are warning signs, but not an indication that a recession is imminent. So a recession in the U.S. starting in 2022, we think is pretty unlikely. As we move into 2023, more likely in the second half of 2023, we think is when the recession risks increase. And we'll have to see when we get there. We're not saying there's going to be a recession then, but we'd say that if there is going to be one, that's where we want to be targeting. That's where how far out we think it could be.
What is your evaluation of the first quarter earnings season so far?
It's been okay. The percentage of companies beating expectations is about where it was last quarter, which is in the around the 75 to 80% range. Last year, it was well over 80%, even close to 90% some quarters. So it's not as many companies are beating expectations, and not as many companies are raising guidance for later on in the year. And so this is typical. It's just 2021 was the exception. It was so good, create a virtuous cycle where companies would beat expectations and raise guidance for next quarter, and stocks would go up, and then it would keep going on quarter after quarter. This is more of a typical situation. And what we're seeing is that companies that don't meet expectations or have to reduce guidance are getting hit very hard. And so it reflects that investors are nervous about earnings growth, nervous about the economy, and they don't want to be in stocks that can't follow through on their guidance and hit earnings expectations.
Looking at the Netflix's results, it seems like that the positive effect of the pandemic disappears. Will there be a negative impact on the tech in general?
Yeah, this is probably not the best time to be in the tech sector or communication services, or the broadly how you want to define technology, because as you said, the pandemic, when we were all stuck at home, we didn't have anything better to do than stream shows on our devices. That's about as close to peak sentiment as you can get. And instead, what we're seeing is an interest, at least in the United States, for people to go out, experience things again, to travel again. And so that's where the interest and the economic momentum is. So it doesn't mean that all those companies are bad companies. It just means that they're not the ones that are best positioned for this point in the cycle.
The work from home stocks like Netflix and Zoom, they will affect it. And how about the big tech like Google and Amazon? And do you think they will affect it also?
Yes, but probably to a lesser degree, because if a company can continue to grow its earnings, investors have shown a willingness to stay with those names. This is different from the dot-com bubble in the late 90s, early 2000s, where many of those companies didn't have any earnings at all. And so when the growth projections slowed, there was no reason to own those stocks. Whereas a lot of the mega cap growth names do generate a lot of positive cash flow. They have a lot of cash on their balance sheet. So there's reasons to own them, but it doesn't mean they can't underperform for a while. But it's a different situation than what you had about 20 years ago with the dot-com bubble.
Investors don't talk anymore about Ukrainian war, and war have any more impact on the market, you think?
From a sentiment standpoint, the market's doing what it always does, and that is it prices in a lot of the risk before the shooting starts, and then actually when the event takes place, a lot of the bad news is priced in. But from here, I don't think investors should sleep on the disruptions to commodities, not just crude oil, but a lot of agricultural commodities, that are produced in that part of the world, and the supply chains coming through the Black Sea are probably far more important than particularly what a lot of people in the United States, who are so U.S. centric in their thinking, realize. And so I think you could see knock-on effects around the world as a result of supply chain disruptions, and that's going to have an impact on stock markets. But from a sentiment standpoint, it looks like a lot of the worst fears were priced in late February, early March.
How do you see the commodity markets such as oil, nickel, wheat, and so on?
So even before Ukraine, it was becoming clear that global supply chains were not running as smoothly as they were before, and commodities, particularly the ones that are globally traded and moved around the world, are going to be affected. And so I think if you're looking out over the next few years, a lot of commodities are probably going to go through these intermittent supply disruptions, which means ultimately there's going to be higher prices for a lot of commodities.
The dollar continued to appreciate. When do you think it will peak?
Yeah, I think as long as the Fed remains aggressively postured, the dollar is probably going to be strong. So if our expectations that the Fed starts to back off a little bit with their rate hike expectations later in the year, that's when we would think that the dollar could weaken somewhat, as the expectations for higher real interest rates in the U.S. Start to moderate.
Emerging market usually suffers when the Fed tightens. And how do you think about the emerging markets?
So we are underweight emerging markets from a global equity allocation perspective. But I think from a bigger picture, what you want to do is focus on emerging markets that are tied to growing economies. For example, a place like Mexico is very much tied into the U.S. economy, and the deglobalization effect of manufacturing being moved closer to end markets actually favors Mexico, where it's less favorable for countries like China. So the broad emerging market indices have huge weights in China. So I think rather than focus on a broad index, focus on regional or even countries within emerging markets that have good ties to end markets that are growing.
Oh, okay, that was my last questions, and that's a really insightful answers, and it really helps me a lot. And see you again soon.
Well, thank you very much. I enjoyed it, and look forward to talking to you again soon.
Okay, thank you. Bye.